Hey everyone, if you've been feeling like your money just doesn't go as far as it used to, you're not imagining it. The world economy right now is giving us a very specific set of challenges, and if you're not adjusting your financial strategy to match, you're likely leaving money on the table, or worse, slowly losing it. In the next 10 minutes, I'm going to break down exactly what's happening in the global economy right now, and more importantly, what you should actually do with your money in 2026. No fluff, no jargon. Let's get into it. First, let's understand the world we're operating in, because your savings and investment strategy should always match the environment. Here's the headline. Global growth is slowing, projected at around 2.7% in 2026. That's below pre-pandemic averages. The world economy isn't in freefall, but it's not booming either. Inflation? It's easing, projected to fall to around 3.1% globally in 2026, but the cost of living squeeze is still very real, especially when it comes to food, energy, and housing costs. Interest rates are starting to come down in many countries. The European Central Bank is expected to cut rates to around 1.5% by mid-2026, and the Bank of England is forecasted to bring rates down to 2.75%. In the U.S., the Fed is expected to cut its policy rate to around 3% to 3.25% by year-end, but the 10-year Treasury yield is likely to stay above 4% due to persistent inflation. And here's the wild card everyone's talking about. J.P. Morgan puts the probability of a U.S. and global recession in 2026 at 35%. That's not a certainty, but it's not something you can ignore either. What does all this mean for you? It means uncertainty is the theme of 2026, and your financial plan needs to be built for resilience, not just growth. Before we even talk about investing, let's talk about saving, because without this foundation, investing is just gambling. Step 1. Build your emergency fund. The rule hasn't changed. 3 to 6 months of living expenses, liquid, in a high-yield savings account. With interest rates still relatively elevated compared to a few years ago, high-yield savings accounts are still paying decent returns. Don't leave your emergency fund sitting in a regular bank account earning next to nothing. Step 2. Kill high-interest debt first. Credit card rates right now are brutal, often 20% or higher. No investment in the world will reliably return 20% annually. Paying off that debt is the best guaranteed return you can make. Step 3. Know your number. Before you invest a single dollar, you need a monthly budget. Track your income, track your fixed expenses, and find your investable surplus, the money left over after needs and a reasonable life. Even $100 a month invested consistently over time will change your financial future. The habit matters more than the amount when you're starting out. Okay, the fun part. Let's talk about where smart investors are putting their money right now. Number 1. Index funds and ETFs. Still the bedrock. If you don't know where to start here. Low-cost index funds that track the S&P 500 or global markets are still the most reliable long-term wealth builders for everyday investors. Morgan Stanley projects global GDP growth of around 3.2% in both 2026 and 2027. Moderate, but positive. Over the long run, diversified index funds capture that growth. Set it up, automate your contributions, and don't panic sell when the news gets scary. Number 2. Bonds. Worth a second look. For years, bonds were boring. Now they're interesting. With rates starting to come down, bond prices go up. The 10-year Treasury yield is expected to average around 4%, which is real, meaningful income compared to where rates were just a few years ago. If you're within 10 years of retirement, adding some bonds to your portfolio makes a lot of sense right now. Number 3. The AI and technology opportunity. The AI investment boom is creating a counterforce to economic headwinds, with real potential for productivity gains in the medium term. Technology-focused ETFs or funds that give you exposure to AI infrastructure, semiconductors, and cloud computing could deliver strong long-term returns. But, and this is important, high asset valuations, particularly in AI-related sectors, still pose real risks. Don't put your entire portfolio here. Think of it as a growth slice, not the whole pie. Number 4. Diversify globally. Don't just invest in your home country. India stands out with projected growth of about 6.8% in 2026, supported by strong infrastructure investment and expanding services sectors. Emerging market ETFs can give you exposure to faster-growing economies without having to pick individual stocks. Number 5. Real assets, real estate, and commodities. If inflation stays stubborn, real assets are your friend. Real estate investment trusts, REITs, let you invest in property without buying a building. Commodities like gold have historically acted as a hedge when economic uncertainty spikes. A small allocation here can protect your portfolio when things get choppy. Just as important as where to invest is where not to put your money. Avoid trying to time the market. With a 35% recession probability floating around, a lot of people are tempted to go to cash and wait. Don't. Nobody, not even the best fund managers on Wall Street, can consistently time the market. Missing just the 10 best days in the stock market over a decade can cut your returns in half. Avoid putting everything in one asset. Crypto, a single stock, a single sector. Any of these could moon or they could crash. Diversification is boring, but boring wins long-term. Avoid ignoring currency risk. Geopolitics is increasingly driving markets, traditional economic logic is becoming less decisive, and currency swings can erode returns on international investments if you're not paying attention. Stick to currency-hedged international ETFs if this concerns you. Avoid lifestyle inflation. When salaries go up, spending tends to go up with them. The single most powerful savings habit is keeping your expenses flat while your income grows and directing that difference straight into investments. I want to leave you with something more important than any stock ticker. The biggest wealth killer isn't a bad economy. It's inaction. People spend months researching the perfect investment while their money sits idle. There is no perfect time. There is no perfect portfolio. There's only starting, staying consistent, and adjusting as you learn. Here's your action plan. 3 things you can do this week. 1. Open or fund a high-yield savings account if you don't have an emergency fund yet. 2. Set up automatic monthly contributions to a low-cost index fund, even if it's a small amount. 3. Review your monthly budget and find one expense you can cut or reduce and redirect that money to savings. That's it. 3 steps. The economy will always have uncertainty. Trade tensions, recession fears, inflation. These are permanent features of the financial landscape. What separates people who build wealth from those who don't isn't access to secret information. It's discipline, patience, and starting. If this video helped you, drop a like. It genuinely helps this channel reach more people who need this information. Subscribe if you want more clear, practical finance content every week. And drop a comment below. What's your biggest financial goal for 2026? I read every single one. See you in the next one.